We're going to go through a multifamily opportunity that I found on Zillow. We're going to analyze everything about this property to come up with a good purchase price. I was going through Zillow the other day. I saw this listing in Portland, Oregon. In Google Maps, it is this property. We have 8 units with a separate lot. Zooming out, we can see the area. We have the Willamette River, 99E, goes up. Portland is in here. And then you have the more rural cities to the south. This is a great location. If I were to get this, I wouldn't have a problem finding people that want to live here. Back in the listing, they're asking for $1.3 million for 8 units. It's 11 beds, 8 baths. It works out to be 5 1-bed, 1-bath, and 3 2-bed, 1-bath. Over 7 days, 24 saves, 340 views. There's quite a bit of parking available. There are 2 lots that are included. There's the additional lot that we saw on Google Maps where it's just empty lot, where it's empty land. You're able to put a little bit more development. You're able to put another building on there. We can go in that later. There is no HOA. The annual taxes is about $6,000, and we are seeing almost $10,000 in actual rent. Currently, 1 unit is vacant and offers the potential for a live-on suite. If you want to have an on-site manager, you wouldn't. For something this small, you would not have an on-site manager. Either you're going to manage it yourself or you're going to have a third party come in and manage it for you. So the building boasts a newer roof, on-site laundry, and extra storage. Okay, sounds good. Let's jump into some of the analysis. Going on the county site, the county GIS map lets you look up tax lots for any property in the county. And it's this property here. We see the smaller building, larger building, and then the side lot here. If we go to assessment, it's assessed at $760,000. It was not sold recently. It probably changed ownership. They moved it from a personal account to an LLC. That's why the sales price is 0. Development codes, that's R7. So that means in Clackamas County, R7 is low density residential. This building was constructed before the zoning laws came into effect. So this is what's considered a legal non-conforming use. It's not conforming to the current zone, but it's still allowed. You just can't build another multifamily unit here. Although with some changes that happened in Oregon recently, on this lot here, you would be able to put up a fourplex, for example, as long as you meet the setback requirements for the front, side, back. Although, just because you're able to put a fourplex doesn't mean it's going to pencil out. A fourplex is going to cost a lot of money to develop here, and so this land isn't going to be hundreds of thousands of dollars. At most, it's going to be probably $100,000 at most. Land, for some reason, is extremely expensive. People have an inflated opinion on what a value should be for land, mainly because they've never dealt with land before. We can see in the listing that they give us exactly how much rent each unit is bringing in. So I think that's for 7 units because one unit is vacant. So that divided by 7 is $1,400. In the tool Land Price Calculator, there's a multifamily price calculator, which tells you per unit what you should be paying. And it's based on income, interest rates, down payment, your required cash and cash return. And so for this particular case, we see $1,400 per unit. We expect to spend about 50%, probably less since there's more units. This expense percentage, that says what percentage of the income will go to expenses. It's utilities, management fees, insurance. If you have vacancies, then it would also go into there. Since it's 8 units, we can probably bring this lower. It's not going to be drastically lower, maybe 45%. That's a good underwriting number. If we can get an interest rate of 6.5 with 30% down, and since this is a much older property, this building is a little bit over 80 years old. It was built in 1942. And so the older the building, the more rundown it is, the more risk is involved. And with more risk, the investor, you, have to have more return. So for that, we should be looking at 12% cash return, a 10%, 12%. If you have a high interest yield savings account, that's 5% right there. That's essentially risk-free. You put your money in your savings, your high interest savings account, it's no risk to you. But you're taking on risk by buying a multifamily property. You should be incentivized to take that risk. Now, obviously, this cash and cash return is not the only metric that you should be looking at. You have cap rates and you have appreciation, you have tax incentives. So number of units, there are 8 units. So let's assume we can get that last unit filled. What should we pay? Now we have a buyer's fee and then closing costs, probably 0.5%. So at $99,000 per unit, this is what we should be offering to the seller. This $773,000 is what we should be offering to the seller for this property. This takes into account what our rental income is going to be, what our desired cash and cash return ends up being, with a down payment of 30%, interest rates of 6.5. Let's assume we can get like a 5.5 if we have a really good relationship with the bank. We could then offer 818 instead of 775. Right, but that's just, we change that number, see what you can get. If you don't want to make any money on this property, you can offer $1.3 million. You're not making any money, but you still have the property. If you're getting a 5% cash and cash return, you can offer $1 million. Like I said, probably looking for 12% cash and cash return because this is a risky property. It's a very old property. It's extremely risky. There's probably a lot of skeletons in the closet, it being so old. But we can run a pro forma. Let's just run a pro forma real quick, just to see what our returns would look like if we were to go somewhere close to $1.3 million. Let's assume we can get the price down to $1.2 million. Let's just look at what that will do for us. There are 8 units at $1,400 each. Let's assume they're right and there doesn't need to be any repairs. We're at 30% down with 6.5% interest. Let's just take taxes out of it for now. Our income is going to be $134,000 annually. So we have our expenses, we have our property taxes, insurance, utilities, our maintenance, vacancies, property management fees, and that gives us our operating expenses of $5,000 monthly with a mortgage payment of $5,600. And that's based off of the purchase price, your down payment, and then the interest rate. So our total monthly income, $11,000. Our operating expenses is $5,000. Our mortgage, $5,600. Our total cash flow is $400 for the whole property. That's terrible. Looking over at the metrics and analytics, our NOI is $73,000. Our cap rate of 6%. If you owned the property outright, that would be your cash and cash return. So if I didn't have to have a mortgage, I would be getting 6%. Turns out we're getting, after our mortgage payment, we are getting 1.5. Remember, you could get 5% in your bank with risk-free. Risk-free. You don't have to worry about the building burning down. You don't have to worry about evicting tenants. None of the hassle that comes along with multifamily. There's none of that, and you're getting 5%. So really, we're losing money on this deal, essentially. We're losing money because of the opportunity cost. We could be getting 5%, so we're losing 3.5% by buying this property. Our debt service coverage ratio of 1.1x. A bank is looking for 1.25 at a minimum. At a minimum. That means we wouldn't even be able to be financeable for this property. Yeah, so you have to put about 40% down on this property to become loanable. And then just some other basic metrics on this property, like your break-even loan amount, your return on equity percentage, still really bad. This cash on cash return metric, this really highlights the level of return for this property, and it's poor. It's terrible. This would not be a good investment at $1.2 million. Like we showed over in the other calculators, in this price per door calculator, we showed that our cash on cash return, our desired cash on cash return is 12%. For a risky building like this, for an older building like this, for this tenant profile, we are needing a 12% cash on cash return. To get a 12% cash on cash return, we need to buy this property for $818,000. In review, we went over this property. We saw what they're offering. We calculated exactly what we need the property to be to meet our profile. To the rental income of $1,400 per unit sustains a property value of $818,000. If you wanted to get up to that $1.3 million valuation, if we were to charge each of these 8 units $1,800, then that means it's $1 million property. $2,200. 1.28 million, that's pretty close. I think if we make this a 3, there you go. So we can make it work at $1.3 million if we were to charge our tenants $2,300. There's no way they'd be able to afford that. There's no way somebody would spend $2,300 on a unit like this, on a 1-bedroom, 1-bath in this area. There's no way. This was a good overview of a property, 8 units in Portland, Oregon. They're asking $1.3 million for this property. We saw that it's actually closer to $808,000. You can still make an offer. You can still offer $808,000. They may or may not accept it. It depends on the person's situation. You never know until you make the offer. But knowing what the property is worth can save you a lot of heartache in the end. Instead of going off of this $1.3 million and saying, okay, I can go 10% less, let's negotiate from there. You should go from first principles saying, what can this property sustain? You go from the rental rates. You go from the expenses. What can this property sustain? What does this property cost me? That determines what the property value is. Thank you so much for watching. If you have any questions, please let me know. I love talking about real estate. I love talking about other people's projects that they're working on. So hit me up. I will see you in the next one.